Hi, welcome to the Q3 macro view walkthrough for 2016. Excited to get things started. Lots happened during the quarter. In terms of our current view and what's happening, not a lot has changed over the last quarter in Q2. We think growth is slowing. The expansion cycle that started post-financial crisis is ending. Believe the Fed may raise rates this year, although I think it's going to be tough as Q3 GDP gets released and it shows that growth is still meandering. I think it's going to be really hard to raise rates in face of that. U.S. stock markets are overvalued. Europe is a minefield, and there is a global currency war that's still happening. And because of all that, we believe being underweight risk assets like stocks and overweight safe haven assets like gold and bonds. Market statistics. So currently, price to earnings ratio based on actual earnings over the past 12 months, that's at 23.9. The Shiller ratio, the Shiller PE is at 26.9. And then the Crestmont adjusted ratio, which they adjust the Shiller PE, that stands at 27.3. And just to provide some context, last quarter, the prior year's price to earnings multiple was 23.3. So we're trending upwards. If you look at where the deceleration in earnings are coming from, you can see it here. This is for Q2 of 2016. You have, sales growth was relatively flat across the S&P, but earnings growth declined 3.9%. Recently, you've seen some downbeat numbers. Alcoa tends to kick off the earnings season, and they had some disappointing numbers recently. Just to put it in perspective, corporate profits have been falling since mid 2014. The cycle peak is what we think that'll end up being referred to in future years, and now we're at the lowest level since Q1 of 2011. In terms of forecasting returns, we walked through this briefly in the last macro walkthrough. Where you buy the market, whatever that price to earnings multiple is, it tends to be, there's a high correlation in future returns. So low starting price to earnings multiple correlates with a high forward 10-year return. This has some limited data. It goes back, shows one point in 1989 and then runs 2000, through today. This chart as well shows the same statistics, but it goes back even further. It shows average, worst, best, and the standard deviations of those numbers, as well as the starting low and ending high price to earnings multiples. And highlighted here is 21.1, although we are closer to 25. So the forecasted future returns return expectations should be very, very low. Again, we walked through this and we've done a blog post on the secular markets. This is a Crestmont research chart. They show red bars are secular bear markets, green bars secular bull markets. And what you'd see on the bottom is those secular bull markets start from very low price to earnings multiples, and then you have what's called a multiple expansion. The price to earnings multiple tends to grow gradually throughout the cycle until there's a peak. And then we have a steady decline in price to earnings multiples. The way that works, and just to provide an example, if the market goes up 10% one year, but earnings of all the S&P companies goes up 10%, effectively you haven't increased the price to earnings multiple. What we've had recently is the market's gone up and earnings have fallen, thereby compounding that earnings multiple and stretching it to levels that, if you look at in terms of previous bull markets or previous market earnings multiples, it's we're the highest since 2019-29. Equities are becoming more correlated. This just shows there's frankly not enough data here. It shows 1995 to 2000. That's a lot happened within those years. There was a currency crisis. And in 2008, 2015, it's showing how there's been, more correlation among asset classes, specifically stocks. I think that's been true, although the last year and a half or so, there's been some variations between the large cap stocks, mainly the S&P 500 and almost every other index. Last year, we had a big pullback in emerging markets, international and small cap, while U.S. large cap relatively was flat on the year. Excuse me. 7-year asset class forecasts. None of this should be a surprise, although it is somewhat downright depressing. From GMO forecasting the next 7 years for real returns net of inflation to be negative in U.S. large cap. None of these returns are all that exciting. Again, when you buy things is very, very critical to what your future returns are going to look like. This is different. This is from BlackRock, and it shows a 5-year asset class return. It is not net of inflation like GMOs. They're a little bit more optimistic about markets. Dividends as a percentage of earnings at S&P companies. Right now, it's a record payout, matching where we were in late 2008. Moving on to macroeconomic data. We got a lot of slides here, so I'm trying to run through this quickly. Current expansion cycle, we're at 87 months, the fourth longest on record, about to be the third longest if we could surpass the 80s, although weakest growth. This little blue line over here, this is the growth that we're at currently. So even though we've had a lot of stimulus monetary occurring, it has not resulted in much growth. Again, even with the fact that we're the fourth longest expansion on record, GDP has been averaging, I think, a little bit less than half of what typically occurs at this point. Non-farm business sector output, that's been, it really hasn't grown. It's just been chopping around, but we had a big rebound post-recession, and it's just been chopping around plus or minus 1% since about 2012. U.S. productivity changes, it's a 5-year rolling period. It's been falling quite dramatically since 2000. Construction spending, again, big recovery off of a severe downturn, and now that's falling again, and we may see that turn negative. ISM non-manufacturing, this is effectively not services, which represents 70% of the economy. This is an important number. There was a rebound to 57 past month. So we're going to see if that trend continues. But that's, currently we're actually in this range over here, which is why our GDP for third quarter went, the forecast ended up slightly increasing from like a 1.213 to 1.6, 1.7 or so. So we'll see some of the other data that's bound to come out. But it's a good sign, just whether or not that's a trend or that's just a bounce off of a really weak prior month. The higher end matters, gas prices don't. You see a lot about, if gas prices are rising, it's great for the economy because the producers make more money. Gas prices are falling, it means people spend more money. So I hear the arguments happening in both directions with the price of oil. But the high end tends to matter more. The high income earners end up accounting for 2/5 of the top 20% ends up accounting for 2/5 of consumer spending. So, gas prices really aren't going to affect their spending habits. Total real per capita auto debt has been rising. Here in Austin, I hear commercial. If you make $350 a week, you can qualify for a $21,000 loan, regardless if you went bankrupt. So that person in that scenario only makes $18,200 a year, and the interest rates are most likely in the 10% range, which over 66 months is about $500 a month. There's no way that someone that makes just over $1,500 a month before taxes kind of afford this kind of loan. And what you're seeing is, if you have a pulse, you could get a car loan. You see it on TV. John Oliver did a news piece on this as well. The auto loan debt, like, moved from subprime housing to subprime auto loans pretty quickly. Total business inventories has been falling since the cycle peak. Core CPI is actually approaching target for the Fed, but what you've seen happening is that the medical care has a very, very high inflation rate of currently around 5%. It's been accelerating since Obamacare. But when you strip out shelter, you're deflationary. If you strip out medical costs and shelter, you're much more deflationary. Shelter is not considered home prices. It's called owner's equivalent rent, which is the amount you'd pay renting your own home or the amount you'd earn if you happen to rent your house to somebody else. So it's not necessarily an accurate statistic in terms of what actually is happening in the real estate market. Average weekly earnings year over year, real average weekly earnings, they have been falling again since the cycle peak. This is why I love working with startups and trying to find ways to add value to them. What this shows is whether it's you're under a year or you're between 1 and 5 years, that's where the most of the jobs are created. This also makes intuitive sense to me. If you are a company that's 15 years old, your growth tends to level off versus your needs at the really young company going from 2, 4, 5, 6 to 10 people. Then your growth ends up leveling off. Your pace of hiring starts to slow. So this makes complete sense to me. And so it's always a topic of debate, it seems like, in presidential races, where they're going to talk about stimulating the small business. They will always be the creators of jobs because their growth rate in the early years is so high, they need to staff up, and then that slows down over time. The value of manufacturers' shipments for capital goods, non-defense though, so it's excluding aircraft industries, that has been falling again. So the data only goes back to 93, but every time it's been negative year over year or severely negative. There were some periods in the late 90s prior to the bubble bursting where it went negative without causing a recession. We've been trending negative since about 2013, and now we're pretty far negative year over year now. The longer run summary, the projections for growth from the FOMC, from the Federal Reserve Committee, Open Market Committee, has been steadily decreasing. Each year they're lowering their forecast for growth, yet they want to raise interest rates, which is interesting. Manufacturers' new order, again, this shouldn't be that much of a surprise from the prior chart, which showed shipments, they're going down. This shows just that other JP Morgan chart with in terms of where we're at in the cycle. This says 86 months. We're really at 87 months. The average cycle, though, the mean is 59. The median is 50. So, we're approaching, 75% in terms of being over the normal cycle. Industrial production, again, this goes back to 1968. Whenever you go severely negative, you end up having a recession. So we're not one data dependent, like the Federal Reserve seems to be really focused on just unemployment. We're focused on looking at all of the data, and all the data seems to be pointing in one direction, which is that we are heading for a period of a recessionary period coming. At least that's what the data seems to show. It's whether or not the Fed will push us over the edge with an interest rate increase, which I think you'll see, or whether or not we'll just get there on our own. Corporate profits, they've been falling over. Again, high correlation between negative year-over-year profits and recessions. So there's a few times where this did not occur, like the late 80s, although you did have a stock market crash, as well as in the late 90s, which you could correlate to the Asian currency crisis, long-term capital management, Russian ruble crisis, and a few other things that were happening at that time. This shows the monetary base, so all of the currency in circulation. So there was a big spike, monetary stimulus, the Federal Reserve, engaging in as much monetary policy as they possibly can. But what you see is actually the currency in circulation, the true currency in circulation does not spike. So this goes up, 10% versus 100% year-over-year gains in the prior chart. The reason for that is monetary policy, as you saw in Japan, doesn't really work that well when you have a balance sheet, when companies have balance sheet problems. So, in the mid-90s, Japan took their interest rates down to zero, but their M2, their money supply, didn't increase. And you're seeing that here is that even though the logic that is taught is 0% interest rates spur companies to buy and consumers and to take on debt, That is true, except when their balance sheets are ripped apart and they're upside down and they've purchased assets in a peak cycle and now they're underwater. They're focused on paying down debt, not borrowing. And so it's not that banks don't want to lend. You hear that a lot. I just met with someone yesterday. It's BS. They want to lend. They're in the business of lending. People don't want to borrow. They're paying down debt. Again, you see that here in the M2 money stock, where the year-over-year changes were nowhere near what the monetary base increase was. So moving on to some international stats. LIBOR's been disconnecting from the Federal Reserve interest rate policy. It's much higher actually, well, slightly higher than it is here right now. It's in the mid 0.8% range. There's a lot of arguments or theories that have been kind of tossed around, one of which is money market reform, which actually happens on October 14th. As a cause for this, it's certainly possible. They also say this tends to happen around credit shocks. Very possible. Deutsche Bank seems to be like a likely cause of that and a likely reason for this continuing, if that is one of the reasons why it's happening. Again, no one really knows, and but it is a sign to watch. Japan is now, or at least was, this was from a few months ago, a top 5 holder in 81 of the 225 names in the Nikkei index. They are the biggest buyer of Japanese stocks in the world right now, and it's something to follow. They're going to buy anything they can to try and stimulate the markets. China real estate investment growth, that has been falling. There's actually been a recent surge since last year. There was a mini stock market crash in China, so there's been a lot of money flowing back into real estate. China fixed asset investment, the only ones that seem to be investing are state-sponsored firms. The private firms, which is this red bar right here, that is falling steadily since about 2012. Now it's approaching zero. You may see a negative year-over-year change, and as well as the overall amount of investment, that line is still trending down, meaning that even this spike in state firms, this fixed asset investment, it's not enough to fully offset the private firms' investments in fixed assets. This just shows a real quick chart of the breakdown of risk, sector, ratings, and maturities that the ECB has been buying. Again, you can access this chart and look at this information more closely. I don't want to spend too much time on that. Percent of government bonds below 1% and percent of government bonds below 0%. It's been down over the last few months, although last month we had a slight increase. Bonds have sold off recently. There's a lot of reasons why that's happened, and a lot of speculation and theories as well. The 10-year moves every 6 months 50 basis points. I think people forget that, and people tend to freak out, and we're right at that 50 basis point move. And the trend in interest rates is lower, not higher. I see the likely scenario, if the trend continues, that you'll see a retracement of the 10-year treasury back down and probably at new all-time lows below 135, which it hit post-Brexit. Unintended consequences. Negative interest rates were supposed to spur growth, consumption. Again, when you have a weak balance sheet, you tend not to consume and borrow and pull consumption forward through debt. Also, if you're a saver and you're saving for retirement and interest rates are lower or negative, you have to save that much more to earn the same return when rates were positive. So again, the prevailing logic was that wasn't going to happen, that you're going to see spending and an increase in GDP. It has not happened. All the savings rates across these economies have increased since NIRP, negative interest rate policies, were announced. Balance sheet strength. This is the last slide that just shows why people are getting worried about Deutsche Bank. They still have not reached settlement with Department of Justice. Their common tier 1 equity ratio is the lowest out of all of the large global money centers. And if they have to settle, they did just do a debt raise of, I think, $4.5 billion total for twice the rate that they would have gotten in the previous year. So they are trying to do everything they can to shore up their balance sheet, but they are a big systemic risk. It's something to watch really closely and not something to take lightly. And what you don't want to see is a Lehman moment for Europe happen via via Deutsche Bank, because it's going to be a really messy situation over there if this company ends up going bankrupt. They become the AIG of Europe. They have the largest derivatives book, I think, in the world right now. So it's something to keep an eye on, and it's something to stay away from, frankly, at this point in time. So that's all for this macro deck. If you have any questions, as always, contact us, and I hope you enjoy it and I hope you learned something from it. Thank you.